like there's no reason why you wouldn't do this. You would actually be probably dumb if you didn't. Hello there everyone, it's Nat here, aka the Wolf of Watertown, and today we'll be talking about dollar cost averaging. Well, I will explain exactly what it means in full. But before we get started, make sure to smash that like button. And if you haven't already, make sure you subscribe to my channel and follow me on Instagram as well at Wolf of Watertown. Now, without further ado, let's get to the meat and potatoes of the topic. Investing is a long-term game, which allows you to build wealth over time. And this happens by you putting money away over time for a long duration. And what some people try to do is time the market. However, a lot of experts say that this is a loser's game. No one can truly time the market. The best investment strategy is known as dollar cost averaging. And a lot of people use this strategy, except they don't even know they're actually doing it. Let's say you either inherited a large sum of money or you won the lottery. Would it make sense for you to take that lump sum of money and put it all in the stock market at one time? Or would you distribute that money and slowly put it into the market over time? And that question, ladies and gentlemen, is what I plan on answering for you today. When experts predict that there's going to be a recession coming up, do you hoard cash and try to predict when the recession is actually going to occur? Do you just sit back and wait for it to happen? If so, this is what's known as attempting to time the market, or thinking you can potentially maximize your returns by buying at the dip. What dollar cost averaging is it requires you to make contributions from your paycheck for a long duration of time. Whether this money is allocated towards your retirement or your regular investment account. It has the contributions set on a fixed schedule, either weekly, bi-weekly, monthly, whatever sequence you have it set up for. You could also do this by doing a manual transfer, which isn't necessarily the best idea. When you automate your deposits, instead of doing a manual transfer, you eliminate emotions out of the equation. When you decide to do a manual transfer too, you may often forget and might not be as consistent with your contributions as you should be. Ideas such as timing the market bring a lot of hype into stock market investing, and this is what gets a lot of people excited. However, dollar cost averaging is the safest investment strategy. It will also return you the most money on your investment over a long period of time. And this is regardless of if the S&P 500 is up or down. It is easy. It requires no work, and it most importantly eliminates all emotions from the equation. So what dollar cost average really helps is to help with the market fluctuation in stock prices. So you might have heard a lot of people say you need to diversify your portfolio. With dollar cost average, you're basically diversifying the price of the stocks that you buy. So let's say you're making monthly contributions to your investment account. One month you buy 10 shares at $10. Another month could be 5 shares at $20. The next month you could be buying 20 shares at $5. In all three examples, you contributed $100 to your investment account. However, due to the fluctuation of the market, the price of each individual share changes. So in one month, you were able to buy more shares, while in other months, you were buying less. So when the share price increases, your money buys less. But when the share price decreases, your money can buy more. The dollar cost average allows you to ignore market fluctuations. Whereas when the market crashes, people typically tend to sell all or most of their stocks. By automating your contribution, you reduce paying the price for when recession or turmoil seems to be the headlines all over newspapers. In these instances, small investors get very scared because of the volatile market. And this leads to them selling at the absolute worst time. This is because by selling at the worst time, you're already accepting a loss. These same small investors then enter back into the market once the market looks good. These are the very common behaviors you see during every single recession. When us, the little people, panic in these situations, big institutions make a tremendous amount of profit. They use the bargain based off pricing in order to take advantage. Warren Buffett is a perfect example of this. He stated that he made a large amount of profit by taking advantage of the discounted prices during the Great Recession. Then he just held on to these stocks until they finally recovered. So as you can see, by applying the dollar cost average, you take emotions completely out of the game. Though it seems to be a very easy and simple method, it is highly effective. And if you are especially a new investor, this is the best route to go. So let's look at this principle by putting it into an example. Let's say you got $100,000 in inheritance. Instead of putting the whole $100,000 into your stock market immediately, you're going to break it up and you're going to put $10,000 into your investment account over a 10-month period. By doing this, what you're doing is you're eliminating some risk. You avoid trying to time the market, which, if we're being honest, most investors have no idea. Experts predict boom and bust all the time, and the majority of the time, they end up being wrong. You implement the dollar cost average method, and by doing this, you diversify the cost of the stocks. You're eliminating all emotions, and now you have time to focus on things that are more important in your life instead of trying to time the market, which you're not guaranteed to be able to do. Instead of doing what the average person would probably do, in terms of the market, whenever there's a disruption, mom and pop shops will typically stop investing altogether. So let's say you're depositing $1,000 each month. In January, you're able to buy 50 stocks for $20 a share. In February, you buy 62.5 stocks, and this happens to be at $16 a share. In March, you buy 83.3 stocks. This is at $12 a share. In April, you buy 58.2 stocks. And you get this for $17 a share. And in May, you buy 43.48 shares. And you get this at $23 a share. This comes out to a total of 298 shares. So over the 5 months, you've invested $5,000. Yet this comes out to be $6,857. So your average share price was $16.77. If you were to invest the $5,000 at once, you might have ended up with higher returns or lower returns, but you don't know for sure. I guess the real question there would be, you feeling lucky? By distributing the $5,000 over a 5-month period, what you did was reduce your risk. So when we think about it, the dollar cost average doesn't necessarily always guarantee you the best or the greatest return. Because if you would have invested the $5,000 in one lump sum, you might have gotten really lucky and happened to just buy at the bottom of the market. It's also possible that you could have bought at an all-time high, which would have mean you would have seen a lot less money on return. So as you can see, by depositing your money throughout that 5-month period, you reduce the potential for losing more money than need be. The only thing we do know is that time in the market rarely works. Most often, a lot of mutual fund advisors have a hard time meeting the benchmark. And if the experts have a hard time beating the benchmark, then it makes sense to go with the dollar cost average strategy. At the end of the day, what you're looking for is to reduce risk and to make investing easy. This will allow you to focus on more important things in your life and actually enjoy doing your day-to-day activity instead of worrying about when to time the market, when to put money in, and being emotionally charged when something goes downhill. That's all I got for you guys this week. I hope you guys enjoyed the video. Make sure to subscribe and like if you haven't already, and share this video with a friend. See you next week.